Good afternoon, everyone. Welcome to today's webinar. My name is Guillermo Sanchez, and today I will be discussing the fundamentals of online trading. So to begin with, I will briefly be explaining to you what is contract for differences, or as is also known as CFDs. Then also we'll be giving you some examples so you have a better idea of how these products work. Then, well, yeah, like I mentioned to you before, I will be showing you how they work with this some examples. And then after that, I will be discussing what is leverage and also what's margin, which are also fundamental aspect of CFDs. Then the next point I will be discussing is basically the advantages and the disadvantages of CFDs. And once we go through that, we go to the second half of this webinar, which is essentially the part of Forex trading, where again, I will be explaining to you what is the Forex market, and also will be showing you how, how you can trade currency pairs in the market, and also, again, giving you some examples. And then at the end, if you have any questions, I would be more than happy to answer them. As well, if you drop any question that you may have, or maybe something that is not very clear, as I go through the, with the webinar, just put it on the chat comment. You put the comment there, I would be more than happy to answer them as soon as I see them, okay? So yeah, just bear with me sometimes if I don't see it straight away, but I will always try to give it a quick look before I move on into the next slides and so on, okay? So what is contract for differences, or CFDs? Well, it's essentially an agreement between the exchange price of an asset when a contract is open and when the contract is closed, okay? This in turn helps you to speculate on the price movements of the financial markets without actually owning the underlying asset, okay? And that is something that you have to bear in mind when you're trading CFDs. You're not actually, you're not trading to, you only trade basically on the price. So let's say, for example, that you believe that the price of the Dow Jones will go up, then you buy that position, okay? If you believe that the price, in this case again, of the Dow Jones will go down, well, basically you sell the position, okay? Also, CFDs are a derivative product. Therefore, the prices are dependent upon the underlying asset to which they are linked, okay? Just as I mentioned to you before with example. Also, you can trade CFDs in a variety of markets, such as, well, the Forex markets, commodities, metals, indices, and also equities. And just one last thing, ladies and gentlemen, there's some trading terminology that I just want to clarify, because I might say this a lot as I go through how the slices. Basically, when you're gonna buy, for example, you say long most of the time, and when you're gonna sell, you sell short, okay? So just bear that in mind when I say go long or go short, okay? So, trying to be everything as clear as possible. So how do CFDs work? Well, essentially, CFDs allows you to open a position with a small percentage in capital paid on front as a term of a deposit. So let's say, for example, here in this example, you can see here with the Dow Jones, as you can see, let's say at the moment, obviously this is not live data, but let's suppose that the price of the Dow Jones is just over $31,000. So usually you will have to put, you go to the cash market. Let's say you go to your bank and you open an account with them, and you wanted to trade the Dow Jones. They will require you to deposit the whole full amount, right? Because that is the price at the moment. However, with CFDs, you don't need to put the whole full amount in order to trade that product. So basically, all you have to do with CFDs, you have to put a small percentage, as I mentioned before. This varies. It could be 20%, 10%, 50%. So that would depend of your account. I will explain to you later why sometimes it might be different. But let's say in this example, the minimum deposit to open a full position of the Dow Jones is 10%. Then all you have to do is put 3,000, as you can see here, just over, $3,133 with 22 cents. Okay, that is basically what you have to put of your money to open one full size of, the Dow Jones. Okay. And also with CFDs, I will explain this to you a bit later, but you will also be based, all the profits and losses of your account will be based on the notional value of the position, okay? So it will be based on that 31,332, okay? That is, I will explain to you later one of the advantages of CFDs, but this is essentially how it works, okay? So yeah, you only have to put a small amount of your money to be able to trade a much, much bigger position, okay? So now, what is leverage? Well, leverage basically enables you to increase your buying power of a particular position by depositing a small amount in capital, okay? It's also expressed in a ratio. So you will see a lot, for example, when you open an account with us, with CFI, we will send you a confirmation email. And in that email, you will see what is the leverage in your account. So it will vary again. So it could be 1 to 30, 1 to 500, 1 to 100, okay? And basically, it's basically what I mentioned to you before. This will tell you how much money you will have to put in order to open that particular position. And that is when margin comes, which is what's the minimum amount in capital required to open a position, okay? In other words, basically the money that you have to put to open that particular position. It's also usually expressed in percentage. So I want to say here, usually what you have to look more is at the leverage. So you will have an idea how much you have to put to open that particular position, okay? Usually you won't be seeing a lot of what is the margin, like the percentage. So you always have to look at the leverage. That I think is much easier just to understand, okay, well, for example, if my account, my leverage is 1 to 30, then I know exactly more or less how much money I have to put to open that position. And yeah, so that is why you need to pay close attention to the leverage in your account, okay? So now, what are the advantages of CFDs? Well, it basically offers you, higher leverage, which can help you to maximize your profits, since any profit is based on the full size of the contract. Just as I mentioned before, in the previous example, even though you have to only put a small amount in capital to be able to open that position, you still gonna be trading the full size of the contract, okay? So obviously any profit, any losses would be based on that. And also another advantage of CFDs is that, well, they give you access to the major financial markets, and also different from, for example, futures contract or spread betting is that CFDs contract do not have an expiration date. So basically you can have a position open as long as you would like, okay? And well, with disadvantages of CFDs, well, it's basically a high-risk product, okay? So essentially, you can lose all your investments. And the reason for that And I want to give you here an example so you understand the risk of trading CFDs. Is that, for example, with the previous example with the Dow Jones, obviously you will be trading the full size of the position. So as you can see here, let's say the price is just over $30,000. Then obviously if the price, let's say for example, the price then moved down to, I don't know, $5,000. Obviously, if you were trading in the cash market, and you therefore, you have to put the full amount in capital, you will only be losing $5,000, right? So you probably work that out. Okay, well, if I had 31,000 and I'm only losing 5,000, well, it's not a big percentage, like 50% of my full balance, or let's say 20%, right? So it's not too bad. But the issue with CFDs is that because you're only depositing a small percentage in your capital, so let's say just 3,000. So if the price goes down 5,000, you will lose all your investment basically. So all that position will be gone, and then depends on how much you have in your account balance. You can basically lose everything. So that is why, like every investment product, you have to be careful with the risk associated with it, and be able to understand them. Okay, so then therefore when you're going to be trading CFDs, you have obviously your trading plans, and then you can manage your risk as well. So let's say, for example, well, if I'm going to be able to open a position on, let's say, one full contract of the Dow Jones, well, how much I'm willing to risk based on my balance. Okay, so maybe sometimes you don't want to open a full size, you might just want to open a small size, and I will explain to you later on in the webinar the different type of contract sizes that you can basically trade with CFDs. Okay, but that is basically the disadvantage of CFDs. Okay, so I just want to make that clear, and let me see if you guys have any questions so far. Okay, it looks like so far it's all clear. That's good. So, okay, let's move on now with the second part of this webinar, where, well, basically, what is Forex trading? Well, Forex is basically, Forex market is a global decentralized market where you can trade, the values one currency versus the value of another currency. So let's say, for example, euro versus US dollars. Okay, and the reason why you would like to trade this in this market is, well, basically mainly for speculative purposes. This counts for about, I think it's about 90% of the total volumes of Forex trading. And the rest 10% is basically for hedging reasons. So let's say, for example, a company based in the UK, and, well, let's say that his supplier is based in Europe. So obviously you have to pay, the company has to pay the supplier in euros. So they will go to the market, then they will do the exchange rate to change pounds sterling to obtain euros, and then that's how they can pay to the supplier in Europe. So that would be the reason why some companies do some hedging. Okay, but that only counts for about 10%. Most of the market movement in Forex is basically based on people just trying to take advantage, hopefully make some money, right? So that is basically the idea behind it. Also, one of the advantages of the Forex market is that it's also the largest and most liquid financial market in the world, with about $6.6 trillion of daily volumes. Just to give you an idea, this is about 15 times the size of the daily trading volumes of all the world stock markets combined. Okay, so I know you have heard a lot about the New York Exchange, also the NASDAQ, and et cetera. Well, Forex market is way much bigger than all these stocks, all the stock markets. Okay, so what this is good also because, let's say, for example, if you're looking to trade a significant size in the Forex markets, you're most likely to have that position executed quickly than, for example, if you're looking to trade on the New York Exchange and want to open, trade a significant size of Apple share, for example. That might take some time, okay, even days. So it would depend on, of the liquidity at the time. But usually with forex markets, the position will get executed and at the same time close, if you choose to do so as well, tend to be quicker than any other market, simply because there is so many traders in this case, trading open and closing position all the time. So yeah, that also is one of the major advantages of forex markets. And also, the forex markets are open. Well, forex market is open 24 hours, 5 days a week. And here I will give a very close explanation of the importance of this, okay? Because most of all the market development and news or anything that moves the price of the currencies is basically happening during the market hours. So let's give you here an example of why. First of all, it's open 24 hours, unlike, for example, the stock markets where they open only during business hours. So the forex market will basically begin on Monday morning in Asia. That's what we call the Asia session. That is basically, let's say if you're based here in the UK, it would be around 10 p.m. on a Sunday. That's where the forex market opens. And then it will go throughout all the, all the business hours in Asia. And then by the time Asia, or in this case Tokyo, we close, London is opening. So basically, how it works is just close and open up simultaneously. This will not affect your position, just to clarify that. And it will continue to be open during the European session, and then we go on, and then when the European session closes, by that time the American market is already open, and we carry on like this until basically Friday, 5 p.m. New York time. So you're based in London would be basically 10 p.m. and also you're based in Asia, where it would be in your Saturday morning. Okay. Okay, so yes, before answering your question, Giovanni, let me go first with the with this explanation, because your answer, I will be able to answer that in a bit. Okay, one of the slides after this one, I will be able to answer those questions. Okay, so just bear with me 1 second, and then we're happy to answer that at the end. Okay. So so perfect. So basically, with the Asian session. Most of this session is focused on the Japanese yen currency pairs, since obviously, as you probably know, the size of the Japanese market and the importance or effect of all the Japanese data that have on the market. So it will be focused on this. So obviously, you should watch very closely all data or information coming out of Bank of Japan, as well as the Ministry of Finance in Japan. Okay, so particularly with any information regarding to exports and imports, as well as manufacturing and trade balance, since, well, as you probably know, Japan is a highly export-oriented country. Then also, if you have any exposure to the Aussie dollar, you should also look out for any data release coming out from the RBA, which is the Reserve Bank of Australia. That is, the central bank in Australia, and everything, concerned with the monetary policy, as well as the interest rate data as well. It will also have an impact on this currency, and the same should apply with the New Zealand dollar as well. Okay, any information coming out of the RBNZ, which is the Reserve Bank of New Zealand. Any information, any speeches regarding to these central banks. If you have an exposure, or for example, you're looking to consider to open any of these positions involving these currencies, yeah, you should be having a close look at this data, because they might have an impact on the respective currencies. Okay. So then once the the Asian session closes, and that only counts for about 22% of the total volumes of the forex markets, then the European session will be live by then, and this is basically the main trading session. Okay, this counts for about 50%, actually more than 50% of the daily total volumes. And in here, you should really keep a close look at any events that will happen during the day, as well as also throughout the week as well. So, as Europe, since it is a block, usually any data coming from the European Central Bank should be enough, but you also should consider or be aware of any data coming out of Germany and France, since, both of these countries are the largest countries in the Union. So any of data might have an impact on the euro, okay, especially if it's unexpected. So if the market are not expecting any, if the data is coming below expectation or above expectation, that usually have an impact on the euro. So yeah, so just be careful with any data coming out, for example, like GDP, that out of Germany or France, for example, that also will be closely watched. Finally, with the European Central Bank, obviously any data release or any speech from the president of the European Central Bank, in this case, Christine Lagarde, will also be important to watch, such as, the interest rate decision. That usually happens on a Thursday around 1 o'clock or 1:30 London time. So again, if you have any exposure on the euro or even on the dollar as well, you should be bear this in mind, because as you probably see in the last 12 months since basically the pandemic began, a lot of the central banks have been having a great impact on the economy for the respective countries. So yes, the market therefore has been also looking to understand a bit more how they will be able to help the economy with all these stimulus packages that have been releasing in the last 12 months. So yes, all this will have an impact on the currency pairs. Okay. So yeah, so for the European Central Bank, you should be looking at any announcement relating to the deposit facility rate. In here is basically where banks might use to make overnight deposit within the European system. Then also all the announcement regarding to the marginal lending facility rate as well, which offers an overnight credit to banks from the Euro system. You should also bear this in mind. And lastly, obviously the interest rate decision, which has a significant impact on the on the economy, but also on the currency. All these speeches announcement regarding to this, you should be mindful of any of this, because the last thing you want is to miss any of these announcements, and that might have a negative impact on, let's say, the euro, and then you were long on the euro, you probably would be losing money. So just keep this in mind when you open in your positions. And obviously there's plenty of financial websites as well. Here with us with CFI, we have a trading tool that we offer for free to our clients. It's called Trading Central, and in there we give you one of the features of this tool is the economic calendar. So, for example, on a Friday night or Saturday, you can log into your portal and look at the economy calendar for the following week. So you can have, keep in mind what is happening for the week ahead, and there is something you have to consider. So, for example, this week, there's not much important like major data release, but again, you have to keep bear in mind of anything that might have some impact. For example, today, there was the data release from the UK on the unemployment rate, and that came better than some of the analysts forecasted. much better than the previous one. So obviously that had a great impact on the cable, on the pound sterling versus the US dollar, where the pound almost reached 140 at some point this morning. So you see, even though today wasn't like a major week for economic data report, it still have some significant impact on the, in this case, on the pound versus the US dollar. So that's why I said that always be mindful of what is happening on the week ahead, so you can prepare your strategy based on that, okay? And then we're obviously also talking about the UK and information coming out of the Bank of England, usually, you know, the governor of the Bank of England, Andrew Bailey, will speak about, you know, the market and what is the central bank thinks about current market conditions and the UK economy overall. So then with that, the markets might make up their minds of what might happen next, okay? Also, tomorrow, for example, there will be also a focus on the UK CPI, which is the consumer price inflation. So yeah, you also keep that in mind as well, because that will have might have an impact on the pound currency, okay? So just to finalize with the European session, you should be looking at I would say the following data and report in Europe. So obviously the European Central Bank interest rate decision and press conferences, any speeches by any European Central Bank official and individual European finance ministers. Also, well, like I mentioned before, the CPI as well as the producer price index, not just for Europe, but also for the UK, and as well as the industrial production, the retail sales, and also the unemployment rate, okay? Those are the factors that you should keep an eye whenever you're gonna be trading, or if you already have any exposure to the euro dollar or the euro or the pound as well. You know, you should bear this in mind, okay? Then once the European session finishes, basically the only market that is left open is the American session. And this is what is, you know, again, similar to the previous session. You should keep an eye on all the, you know, US economy data and reports that comes out throughout the New York session, particularly from the Fed and also for the FOMC meetings, okay, which well, the FOMC stands for Federal Open Market Committee, whose members are responsible for the monetary policy in the US. So again, any information, any speech, any announcement coming out of these meetings or the Fed, keep an eye on that, because might have an impact on the dollar, okay? Well, again, also other data that you should consider as well was similar to the one I mentioned before, like for example the PPI, the Producer Price Index. You know, where, you know, just for those of you who don't know, this measures the change in the price of goods sold by manufacturers. So it's a leading indicator of consumer price inflation, which counts for the majority of overall inflation. Okay. So again, and then another report that might be coming out as well during the US session is the crude oil inventory. So if you have any exposure to oil, you might want to keep an eye on this, because again, any unexpected release or report might have a significant impact on the price of this case, or especially with, you know, again, since the pandemic, a lot of things have been happening in the markets, and, you know, all these reports has been now being close, they have been watched closely a lot by the market. So, you know, just keep an eye on that as well, okay? And then, well, my final point before I finalize with the explanation of the importance of the market hours is, if you have any exposure to the stocks, not just in Europe, but also in the US, just bear in mind of earnings season. So as you probably, I don't know if you have already read in the news, but you know, in the since last week, there has been earning reports, not just in Europe, but also in the US. So there have been, for example, last week was a report for Goldman Sachs, and also, well, the big banks basically. Some of them, such as Goldman, and they have better than expected earnings. So that had a positive impact on the share price. So let's say, for example, you were short on the Goldman Sachs price and that news came out and you missed it. Let's say you were not available or for whatever the reason it might have been. Yeah, you're probably losing a significant amount in your position. So, just bear this in mind. For example, today, there will be, Netflix, for example, they will be reporting the earnings. And also one of the things that you should also consider, especially with stocks, is that these earnings reports might come out even before the market opens, and also when the market, after market close, okay? So that basically means that, for example, Netflix will come after market close today. So if there is any positive earning report, it's better than what the market expected. That will have an impact on obviously on the share price. So the next day when the market opens, when you are able to trade with us, with CFI, if that is the case, yeah, you just have to bear that in mind that even though you saw the report, you might not be able to trade that stock at the moment, and you have to wait until the market opens the next day, basically. So yes, so this usually happen around 9 p.m., 9:30 p.m. London time. So just bear that in mind. You can find this information online when the reports will come out. So yes, just wanted to let you know about that, because sometimes that happens and you miss it, and you have an exposure on these stocks. Yeah, the last thing you want is to be caught in the wrong side of the trade. Okay, so yeah. So that is basically it for the trading hours of Forex. Now let's move on with how to trade Forex, okay? So as you can see here, I just took an example with the euro versus the US dollar. The reason why I did this is because pretty much everyone trades euro dollar. And what I mean everyone, I mean, any trader, cousins, siblings, brother, sister, even grandparents as well. Everyone has traded at least at some point in their life, if you are a trader, the euro dollar. So yeah, it's basically the most common currency traded currency. So yeah, so here as you can see, you have the base currency, which is the euro, and the counter or quote currency. The main difference between these two, and that is the reason why I would suggest you to memorize this, is because the account denomination will be based on the base currency. So let's say, for example, I'm looking to trade one full contract of the euro versus the US dollar, which is 100,000. That would be 100,000 euros, okay? Not dollars, but euros. And in the next slide, slides, I will explain to you the different contract sizes, but just to make things simply right now, if you're trading euro dollar, the denomination of that position will be based on the euro. Similarly, if you're looking to trade USD versus the Japanese yen, for example, it would then be 100,000 US dollar. Okay, so always bear in mind with the base currency, because that is the denomination of the position. Okay, so now the contract sizes of what you're going to be trading currencies, also some, well, as you can see here, oil, silver, gold. You have three types of contract sizes. So the first one is the standard contract or standard lot. And it's also another trading terminology, which is, as I mentioned to you before, an example is 100,000 units. So again, like I told you before, you're looking to trade euro versus the US dollar, it would then be 100,000 euros. If you're going to be trading pound sterling versus US dollar, it would then be 100,000 pounds. Okay, then for the mini contract would be 10,000, and for the micro contract would be 1,000. Okay, so obviously the bigger the contract size, the bigger would be the profit, and also, well, the losses as well, if that happens to be the case. Then with gold, one standard contract is 100 ounces, one mini contract is 10 ounces, and micro contract is, as you can see here, 1 ounce. Then with the silver, it would be 5,000 ounces for the standard contract. For the mini contract, 500 ounces. And for the micro contract is 50 ounces. And for the oil, as you can see here, one standard contract is 1,000 barrels. For the mini contract, it would be 100 barrels. And for the micro contract, would be 10 barrels. And this is another table that you also have to memorize because this is set by the, this is how it works. And also, if you're going to be trading on the MetaTrader, just bear in mind that on the platform, it will not appear like this. It will also appear as a volume. And it would be usually for the standard contract of, let's say, the euro dollar, it will be 1.00. Okay, and for the mini contract, it would be 0.10. And for the micro contract, it would be 0.01. So just bear that in mind. If you don't have any experience on how to use the MetaTrader 5 in this case, well, tomorrow I will have another webinar where I will be showing you how to trade on the MetaTrader 5. So you haven't signed up for that one. You can do so on our website. You go to the webinar section, and in there you should be able to register for that webinar tomorrow, same time as this one, 2 p.m. London time. So if you're interested, just please go ahead and sign up for that one. But yeah, so this is basically the contract sizes when you're going to be trading, well, not only the currencies, but also metals, commodities, okay? So just bear this in mind when you're going to be trading. Now, based on your question, Giovanni, so let me just check that again. Okay, so answering your question about the leverage. So let's say, for example, you have 1 to 100 leverage, as in your question. You will basically, to calculate how much money you have to, okay, so basically, just to clarify, Giovanni's question is about leverage. So on my account, I have a leverage of 1 to 100. What does this mean? For every euro dollar, for example, I buy, how much actual money I will be trading with on this leverage. Okay, so here you can see with the one standard contract of the euro dollar, as per your question, if you do know exactly how much money you have to put to open that position of the euro dollar, all you have to do is get the 100,000 divided by 100, and the result is basically what you have to put to open that position. Okay, so in this case, if you divide the 100,000 by 100, that will be, well, 1,000, right? So then you will have to deposit 1,000 euros to open one standard contract of the euro versus the US dollar, okay? Also, similarly, if you're gonna be trading the mini contract, it's exactly the same process. All you have to do is divide 10,000 by the leverage. So in this case, is 100 or 1 to 100, and then obviously you will need to deposit 100 euros to be able to open that position. Okay. So I hope that is clear, Giovanni, and also for everybody else. So that is essentially how it works. Okay, so you have to first find out what is a standard contract, as you can see here on the table, and then all you have to do is divide it by your leverage in your account. Okay, so I know in the question of Giovanni, he was asking, saying the 1 to 100 leverage, but it could also be 1 to 50, 1 to 30, or 1 to 10, and so on. So basically, all you have to do is get the the standard, the contract size of that particular product, and then divide it by your current leverage, and the result of that is basically what you have to put of your money, to open that particular position. So also just bear in mind, at least with the currencies, that, as I mentioned to you, the best currency, that is the denomination of the position. So if you are, for example, trading the US dollar versus the Japanese yen, then it will not be 1,000 euros. It would then be 1,000 US dollars. Okay, so just bear that in mind. And then for gold, silver, and oil, it would basically be in US dollars. Okay, that is the denomination of the rest for the metal and commodities. Okay. So okay, so it's all clear now. Okay, no problem, Giovanni. You're welcome. Now let's move on to the next slides. And here is where I explain to you what is a pip. Okay. So a pip is essentially the smallest increment in price fluctuation in currency prices, okay? It's also 100%. And it's basically the fourth decimal. So in this example, let's go with the same euro versus the US dollar. Let's say, for the sake of the argument, that the current price of the euro versus the US dollar is 1.1806. So the pip is basically this value over here, number 6, okay? So every time this number goes either up or down, that will have an impact on your profit and losses as well, okay? So every time, you know, there's number 6, this decimal over here, the fourth decimal goes up and down, would be 1 pip. Then if the third decimal, in this case, the 0, goes up or down, that would then be 10 pips. And then with the number 8, every time that goes up and down, would be 100 pips, and the number 1 would be then 1,000 pips. Okay, so yeah, so just bear that in mind. With what is a pip is basically the fourth decimal of the price. Okay, and now you probably wonder, okay, perfect, I know what a pip is, but what is the value? You know, like, okay, Guillermo, what happens if that number 6 goes up to 7 or goes up to 8? So how much money I will be making or losing? You know, it could be also the case. Well, in that case, the value of the pip, it varies, again, based on the contract size. So for all the contracts, a standard contract for currencies, it will be $10, the value of that pip, okay? So just going back to the previous example, if that number 6 goes up to 7 and you were having a long position, you will then be making $10 for that particular position, okay? And then if you were trading a mini contract, it would then be $1. And if you were trading a micro contract, it would then be 10 cents, okay? So again, memorize this table again. I'm sorry for all the things that we had to memorize, but all these are basically set up by, you know, how the approach works. So yeah, just bear that in mind, that every time you're trading the standard contract, just as per the question of Giovanni's before, if you were trading one standard contract of the euro versus the US dollar, where you have to with the leverage of 1 to 100, where you only have to deposit 1,000 euros. Basically, if that position went up for 1 pip, then you will be making $10. Since that also, yeah, as well, guys, just bear in mind that the pip value will always be denominated in US dollars, okay? So just as an example before of Giovanni's questions, where you were trading euro versus the US dollar, even though you have to deposit 1,000 euros, the pip value will be in dollars. So obviously the platform will calculate this automatically. So if your account currency is in euros, for example, it would then be your profits or losses would be based on that currency. And then, yeah, so just bear that in mind, okay, that the value of the pip will always be in US dollars. And then for the gold, as you can see, we're also similar to the currencies. A standard contract would be $10 a pip, $1 for the mini contract, and for the micro contract would be 10 cents. For the oil, just basically the same. And for the silver, that is a bit different. As you can see, the value of the pip for silver, the standard contract is $50 a pip, $5 a pip for the mini contract, and 50 cents for the micro contract, okay? So I see here that we have another questions. So can I get all these lectures in form of PDF or video? You can get it on video. Yes, we usually post our webinars on our YouTube channel. So if you go to YouTube and just type CFI, you will be able to see all the webinars that we do. Obviously, all my webinars, as well as my webinar for tomorrow. We also post that one there. And all the other webinars that some of my colleagues do as well. They will all be posted in our YouTube channel, okay? So yes, so if you go ahead and to our YouTube channel, you should be able to see all these lectures, okay? Okay, now we move with what is a spread, okay? So basically, essentially, a spread is basically the difference in price of, the bid price and the ask price. The bid represents the price at which the broker is willing to buy, and ask represents the price at which the broker is willing to sell. So let's give you here an example of how this look on the platform. As you can see, you will have two prices, okay? One, which is sell from your trader's point of view. So this would be the bid. And then you have the ask, which is basically buy. And as you can see here, you have two different prices. The difference between this is a spread, okay? That spread is basically the cost of trading. So as you can see here, the spread between the euro versus the US dollar is 19. Just bear in mind that on the MT5, on the MetaTrader 5, the platform, the spread will be in points. So how much is that in pips? Basically 1 0 to the left. So it would be 1.9. So let's say, for example, you're trading, again, the previous example I was giving you before with the euro versus the US dollar, one standard contract, which is 100,000 euros, and your leverage of 1 to 100. So we already know that would then be 1,000 euros to open that particular position. Well, the spread, the cost of that trade, if you don't have any commission in your account, so only the spread, it would then be $19, okay? Or well, they do the equivalents on the platform already. So let's say, I don't know, 15 euros or 14 euros or something like that, okay? So that would be for the standard contract. Then if you're looking to trade the mini contract, it would then be $1.9. And if you are trading the micro contract, it would then be 19 cents. And again, this will always be denominated in US dollars. So just bear that in mind when you're going to be trading as well, because this is part of the trading cost. So yes. So you have that on the platform. So also you can calculate that as well, how much is the cost per trade. And this is basically what the spread is. Let's see if we have any questions so far about this. No, okay, perfect, all good, excellent. So yeah, so I hope it's all clear. And now we just move with basically the final slide of this webinar, which is what is a swap rate or rollover? Well, this is essentially an interest that you earn or you pay by holding a CFD position overnight, okay? So let's say, for example, that you are trading the euro dollar and you hold that position until next day. Let's say you open up today and then you decided to close that tomorrow. If you were long, usually for the currencies, you would get paid an interest, okay? However, if you were short or you were selling the position, you will be you will have to pay that interest, okay? And this only happens if you hold the position after 10 p.m. London time, or in other words, midnight server time. So that is a timing that you will see in the platform. That is what we call server time. So yeah, based on where you are located, yeah, you will have to either earn and pay for that particular position, and it only applies to certain type of clients, okay? Just for number of individual reasons, it might not apply into your account, but again, just double check that with your account manager or your representative here at CFI, just to make sure that if you don't know if you're paying or not, just bear that in mind, because also, again, if you have to pay, that also be part of the cost of trading. And well, if you hold the position on a Wednesday, you will get charged twice. Well, 3 times, sorry. So it's basically for the weekend, Friday, Saturday, and Sunday. that is the reason why you get charged more on a Wednesday. So yeah, I just want to quickly let you know about this because this also is part of CFDs in most of the cases anyway. But again, like I mentioned to you before, it will depend of your particular circumstances. And well, that is basically it. Now, I just wanted to give you for those of you who don't know who we are, what we do. Well, here at CFI, we were established about 15 or 16 years ago, basically 2005. And since then, we have been expanding our presence globally. We now have 6 offices around the world. So we have the headquarters in Dubai. And again, we are also regulated by the DFSA, which is the Dubai Financial Authority over there. Then we also have an office in Lebanon, one here, obviously here in London, and the United Kingdom. We have that office, and we also regulated by the FCA, which is the Financial Authority in the UK. Then we also have an office in Jordan, Mauritius, and Cyprus. And yes, we also are regulated by their respective financial authorities in those particular jurisdictions. And then what type of product you can trade with us? Well, obviously CFDs, but we also offer futures as well as cash account as well. So you can trade stocks, forex, commodities, metals, oil, and treasuries as well. Okay. So if you're looking to trade on these particular products, we offer over 5,000 instruments, okay, so across the board. So yeah, it's one of the few brokers that we actually able to offer pretty much everything that is out there. And we still, we always aim to help our customers more, and we are regularly adding more new products and services as well. So if you want to keep an eye on that, please follow us on our social media platforms, as LinkedIn or Instagram, where we currently, regularly posting any information regarding to our products and services. And then, well, you are interested to know why would you come to CFI if you're not a client already, is well, we offer leverage up to 1 to 400. These are for the professional, those who classify as a professional client. If not, if you classify as a retail client, then will then be a 1 to 30. And this is for the London office, okay? We are regulated by the FCA, and this is what the regulator tell us. So yeah, this is basically by default. Then for the spread, it will depend of what type of account you have. We have 2. So if you go on the premium account, you have a spread as low as 0.0. And you have a small commission on top of that. But again, it would be one of the most competitive accounts that you will see in the market, okay? And then on top of that, you will get your fast execution, you leave liquidity, all these attractive trading conditions, all the products I just mentioned. And also, more importantly as well, we have customer service 24 hours a day, basically 5 days a week, okay? And with that, well, like I mentioned to you before, if you want to follow us on social media to, keep up to date with what we're currently offering, please do. And also for those of you that maybe you might want to have, you don't understand everything completely, you still have some question and would like to speak to me, I'm more than happy to take any calls or answer any email. So as you can see there, that's my email address, g.sanchez@cfifinancial.com. And if you would like to speak to me, you can email me. I'm more than happy to arrange a phone call and discuss anything about, CFDs, the forex market, or anything about what is currently happening in the market. Okay, so I'm more than happy to do so. And with that said, I conclude today's webinar. Just before I close out, I just want to make sure if you have any more questions, like you have been doing before, just post it on the chat comment or on the Q&A option, okay? So it's gonna give it 2 more minutes. If not, well, it has been a pleasure once again, and I hope you all have an lovely afternoon or evening for some of you, okay? Okay, seems that we don't have any more questions. So, well, once again, guys, ladies and gentlemen, has been a pleasure, and hope have you all have a lovely afternoon. Goodbye.